What's up, crypto fam? You're watching Altcoin Insider. This morning, while I was doing my 15-minute run on the sand at the beach, and running on sand is great not just for your stamina, but for your ligaments too, I caught myself thinking about something interesting. Trading in the crypto market is a lot like this run. If you're running on solid, predictable ground, you can control your heart rate, pace, and distance. But if you throw yourself into the quicksand of hype, you get stuck, drain your energy, and eventually you might even get injured. And what happened recently with the Gork token is the perfect illustration of this quicksand. Today, we're going to break down the anatomy of this pump. We're going to pit absolute crypto garbage against solid, heavyweight assets like XRP and HBAR. I'll show you on the charts and through metrics why some assets build your capital, while others are designed solely to take it away from you. So, February 24, 2026. The broader market is tense. Bitcoin is dumping towards 60 amid US inflation data. And then Elon Musk, a guy who can move billions in market cap with a single tweet, posts on his X account, Gork returns today. What happens next? Algorithms, trading bots, and an army of retail investors read this signal. The Gork token on the Solana network, which, by the way, is just a parody of the grok AI instantly moons, by 520% within a single trading day. The daily trading volume jumps to an insane $20.9 million, and the coin's market cap skyrockets from a measly $1 million to $14 million in a matter of hours. Sounds like a fairy tale, right? Throw in $1,000 in the morning, take out $5,000 by the evening. But let's take off our rose-colored glasses and look at the order book and on-chain data. How do these schemes work? This is a classic liquidity trap. The Gork coin had been stagnating for almost 300 days. It had minimal liquidity. Insiders and smart money, who had likely accumulated positions in advance or set up sniper bots reacting to Musk's tweets, are the first to buy the asset. When the price goes to the moon, all the crypto groups start blasting it. Retail gets hit with massive FOMO, fear of missing out. Regular traders start buying Gork at the absolute top, thinking it will fly even higher. And what do the big players do? Exactly. They start unloading their bags onto these new buyers. You become their exit liquidity. As soon as insiders lock in their profits, the order book empties out because there's no real demand for this shitcoin. The price drops like a rock. The market cap deflates from 14 million back down to 6 million, and thousands of people are left holding worthless tokens. Remember the golden rule. With meme coins, you're not investing in technology. You're playing a game of who can hit the sell button faster. And trust my experience, an algorithmic bot will always hit it faster than you. XRP, the institutional standard. Now let's move from the casino to real business. Let's look at assets backed by real tech, partnerships, and multi-billion-dollar volumes. Let's start with our favorite, XRP. While casino tokens pump and die in a single day, XRP continues to build global infrastructure. Yes, we recently saw a market dip, and XRP is trading around 1.35. But let's look at the context. First, Ripple officially announced a new developer funding model for 2026, focusing on integrating the RLUSD stablecoin. These aren't just words. This is the foundation for a massive DeFi ecosystem within the XRP ledger. Second, look at the volume. Just recently, XRP became the absolute leader in trading volume on Upbit, South Korea's largest exchange, grabbing over 14% of the platform's daily volume. That's nearly $250 million. It even surpassed Bitcoin in trading interest in Asia. The Asian market has always been a liquidity driver for XRP, and that demand hasn't gone anywhere. Let's switch to technical analysis. Right now, the relative strength index, RSI, on the daily chart is around 45. That is an absolutely neutral zone. This means the asset is not overheated, unlike meme coins where the RSI shoots past 90 right before the inevitable dump. We can see clear levels. The closest support zone that is absolutely critical for us to hold is the 1.37 block. If the bears push through this zone, we might go down to test the local bottom all the way to 1.24. But pay attention to the resistance. We have a strong level at 1.51 and a key barrier at 1.57. If we close a daily candle above 1.57, we open the road to 1.97, and beyond that, a target of 2.41 is looming according to the Fibonacci retracement. And this move will be backed by real demand and ETF inflows, which have already exceeded $1.3 billion. Do you feel the difference? Here we are analyzing liquidity, macroeconomics, and the areas of interest for major players, instead of trying to guess what Elon Musk is going to tweet today. Hedera, HBAR, the corporate heavyweight. Moving on, my second favorite for a fundamental portfolio is Hedera, or the HBAR token. If XRP is the king of cross-border payments, HBA is the foundation for the corporate sector and real-world asset RWA, tokenization. What's in the news for February 2026? It's just massive. The U.S. Department of Transportation, U.S. DOT, published a patent for a national road usage system powered by hashgraph technology. Just think about it. The U.S. government is validating Hedera's tech. On top of that, logistics giant FedEx has officially joined the Hedera Governing Council. This isn't a dog meme. This is logistics, government patents, and real-world utility. Furthermore, the first U.S. spot ETF for HBAR launched on the market and has already absorbed over 1% of the entire circulating supply, which is more than 521 million tokens. This creates a classic supply shock. When institutions buy up the asset and lock it in an ETF, fewer coins remain on exchanges for trading. If demand persists, this inevitably drives the price up. Looking at the technical analysis on the HBAR chart, we see breakout attempts. Recently, the asset surged 12%, testing crucial resistance at the 0.11 level. Our ironclad support right now sits at 0.09. Technical patterns suggest a high probability of a bullish reversal. As soon as we confidently break through and test 0.11 from the top down, turning resistance into support, it opens up the potential for a rally of at least 50-60%. Yes, the ecosystem still lacks liquidity. In the DeFi sector, the TVL is only around 58 million. But the integration of the Hedera EVM on major exchanges like Kraken is gradually solving this problem. HBAR is a marathon, not a sprint. Strict risk management framework. And now for the most important part. Why am I putting such a strong emphasis on the difference between Gork and assets like XRP and HBAR? Because your long-term profitability depends not on how many X's you catch on one random shitcoin, but on how you manage your risks. Here are my personal rules for strict risk management, which I've developed over years of analysis and losses in this market. Diversification and portfolio allocation. Your portfolio shouldn't be made of hype. The optimal structure. 80-90% of your capital should be in fundamental assets with clear technology, like Bitcoin, Ethereum, XRP, and HBAR. Only 10-20% can be allocated to high-risk speculation. If your Gork goes to zero, you only lose a tiny fraction of your deposit. But if XRP does plus 80%, it will easily cover any losses. Position sizing. Never go all in on a single trade. The risk per trade should not exceed 1-2% of your total deposit. If you trade fundamentals using technical analysis, you always know where your stop loss is. For example, with XRP, if we take a position from 1.37, it's logical to hide our stop below 1.3. we clearly understand our risk. With meme coins, stop losses don't work due to wild slippage. The price can blow past your stop by 30%, and the exchange will close you out at the worst possible price. Scaling out. Taking profits. Many beginners see plus 100% on their screen, get greedy, and wait for plus 1000%. They end up in the red. Implement a scaling out strategy. Did the coin hit a key resistance level? Lock in 30% of the position. Move your stop to break even. Let the market do whatever it wants after that you're already in profit. And this is especially crucial if you do dabble in pump schemes. Got your 2x? Take out your initial capital and let the remaining free position ride. Information, hygiene. Stop trading the news from Twitter unless you're using professional software. By the time you see news in a Telegram channel that a token pumped, it's already too late to buy. The move has played out. You are buying from those who got in before the news. Learn to read charts. The chart absorbs everything: fear, greed, and insider info. Guys, the crypto market is a machine that transfers money from the impatient to the patient. Those who chase 500% pumps from Elon Musk's tweets will always end up as liquidity donors for smart money in the long run. But those who study the technology, track institutional adoption, understand why the Hedera Governing Council needs a patent from the U.S. Department of Transportation, and why XRP is capturing volume on Korean exchanges, they are the ones taking real profits. Choose your path consciously. Build your foundation on solid ground, not on the quicksand of hype. That's all for today. If this breakdown helped clear up the market situation for you, hit that like button, subscribe to the Altcoin Insider channel, and definitely smash the notification bell so you don't miss my daily reviews. Drop a comment below. Do you hold meme coins in your portfolio, or have you fully switched to fundamentals? It'll be interesting to read. Manage your risks and trade with a cool head. Huge profits to everyone, and see you in the next video.